ऐड करूं सबको?
Yes, allow the members.
allow करो.
किया सबको.
Yes. We welcome all the members at JP Nagar CP Study Circle on a webinar with a very important topic, overview of the UAE corporate law and its implications on the free trade zone. And today we have with us the eminent speaker, C. Rajiv ji and C. Janak bhai. They are long way from the Dubai and they have joined us to share their views. So without now wasting much more of time, and we have already delayed by 4 minutes, so we'll first run our institute motto song. So please remain in alert mode while we play our institute motto song.
य एष सुप्तेषु जागृति य एष सुप्तेषु जागृति कामं 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 कामंशो पुरुषो निर्मिमाणः निर्मिमाणः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शितः सर्वे तदूनात्यपि कश्चन
कभी मैंने क्या मारा?
Thank you, members. Now we request all the members to please remain mute during the sessions, and we'll be allowing all the members to post your queries in the chat box. So queries, if you have, you can just write it in the chat box, and the speakers will try as per the available time. They will reply to each and every queries. And today's chief guest, C. Anurag ji, the chairman Dubai chapter, he is also going to join us. If time permits, then we'll also allow him for sharing his.
Jayesh bhai, he is there. He joined. Anurag ji.
Yeah, so Anurag ji, he's already with us. So we welcome Chairman Dubai chapter, C. Anurag Chaturvedi ji. Thank you very much, sir, for being with us and sharing your valuable time. So before the formal introduction of the sessions, I would like to hand over the Pinky madam. Pinky madam, please, if you can just formally introduce the chairman, sir, and then sir can share his important views with us.
Yeah. Thank you, Jayesh bhai. Anurag ji, I myself, CA Pinky Kedia, Regional Council member of WIRC, Western Region Council, and I'm also the past convener of JB Nagar Study Circle. We have more than 1,600 members in our study circle, and it's the largest study circle in the region. So, and we are fortunate that you had joined our webinar, and we hope to meet you in person also. So whenever you come to Mumbai, please contact us. Please let us inform so we can make a physical meeting with you for our study circle. And sir, I request you to say something for our benefit of our member of study circle. Anurag ji.
Thank you, Pinky ji. Thank you, Jayesh ji. It's my honor to be here along with all the members out here. And I think the topic is so prominent that the more you talk about it, the more you learn about it. So I never miss an opportunity, because even every day we have some other sessions that is ongoing on this particular topic, because I believe as a chartered accountant, it's very apt time, and there's no time better than this in the professional life of one of the member that can exist, because we have been born in India and we have been practicing in India, many of our members practicing in India. But all when we talk about taxes, we dated back to 1961. So what happened that time the law was enacted? What was the circumstances? And since then, the tax laws and reforms have, upgraded and amended and ratified by so many places and so many circumstances out there. But in the UAE, we are at the forefront of situation where we going to see in next 5.5 months the law going enacted and businesses adopting that. So I think that's something which is very unique, and that happens only once or twice in somebody's lifetime. I mean, in UAE, we are fortunate to see this 5 times in last 5 years. So we have seen VAT coming in picture. We have seen economic substance regulation coming in picture. We have seen excise. Now we have seen corporate tax. So friends, I want to share with you that whenever the new law comes into picture, its implementation is something which is very different than its compliance. So a lot of members travel from India, and they wanted to seek a career out here in the UAE, and either in terms of practice or joining the employment, because there's ample opportunities for people into international tax field, the corporate tax field, the transfer pricing field, the regulatory field, which is like, because whenever the tax comes into picture, obviously the corporate governance also comes in picture, and a lot many other ancillary services that also get triggered at this point in time. So opportunities are immense in the UAE at this point in time for every professional who is some other way around connected with the tax field. However, what I'll say that while my other colleagues, Rajiv, Hira, and Janakji, we're going to disseminate more about the taxes. I'm not going to talk much about that because they are also experts and they're going to share more insight about it. All I can say to you all is that these developments are very unique. So please take the law, take the Bear Act, which has come up, and read through it, analyze it in your own way, analyze in your own understanding, and then take the guidance of these webinars and seminars, which is happening here, where the speakers are talking about, they're sharing their own insight. But remember one thing, friends, I appealed in Dubai chapter when I done an event. I said, never rely on information which is floated, because you are a professional, you're going out to the people, and the people who are going to meet you rely on the information that you're going to provide it to them. So please ensure that, before you pass on any sort of information to your client, to your organization, or your colleagues, your seniors, your board members out there, please ensure that you have done your homework in relation to the law. Because as we can comprehend the law, you as a chartered accountant can also comprehend the law pretty much. So once you comprehend and you listen to our perspective, I think there may be certain more added value and advantage that you can trigger and can add value in relation to that. So with this, I will leave you with a thought, and I will also encourage each one of you to read the UAE law, which you can download from Federal Tax Authority website or Ministry of Finance website. It's available. You can read through it, and all the speakers are here to answer your queries and support you in that relation, friends. Thank you so much for giving me this opportunity to talk to you, and looking forward to embracing my knowledge and learning alongside of all of you. And I'm always available. You can follow me on Instagram, Twitter, and LinkedIn as well. So if you have any queries, concerns with respect to UAE, I'm always at your available steps out there, and can support you in that mission. With this note, thank you so much.
Thank you, Anurag ji, for your valuable, important opening remarks. And I would like to thank Virak Bhai also, because he helped us to have the Anurag with us today. So thank you, Virak Bhai. Thank you, Pinky Madam, for introducing the Chairman Dubai chapter, C. Anurag Chaturvedi ji. So thank you, Pinky Madam, for being with us from there. We know that you are attending the RRC, but sparing your time, valuable time on these occasions. Thank you very much for that. Now it's a time to formally introduce today's both the speakers, CA Janak Panjwani sir and the CA Rajiv Hira sir. They both are waiting for us, and the members, almost more than 200 members, are eagerly waiting for us to have the today's session. So without taking much more time, I would like to now
Yes, sir, I will first. I would first like to welcome both our speakers on behalf of JP Nagar Study Circle, and then I will just start with a formal introduction quickly. Firstly, I would like to introduce CA Janak Panjwani, sir. So he is a qualified chartered accountant who has been in Dubai in past 30 years, for past 30 years. So he is there in Dubai for past 30 years. He has immense experience with respect to audit in Dubai. He has been handling audit in Dubai. He is a director in Putran Chartered Accountants, Dubai since 2000. CA Janak possesses knowledge, technical skills, and professional know-how in the field of auditing, VAT, ESR, transfer pricing, and international taxation. He has a keen understanding of the subtle aspects of international financial reporting standards, IFRS. CA Janak has served as treasurer of the IBPC Dubai, committee member of Dubai chapter of ICAI, joint convener of study circle committee of the chapter, and also as the election office of Dubai chapter of ICAI. CA Janak has been a speaker at many professional conferences and has written articles in the professional journals as well. So this is about CA Janak ji. We also have with us CA Rajiv Hira. Just to formally introduce him, I would like to mention that he has a high caliber. He is a high caliber finance professional with an experience of leading roles in private and multinational financial institutions for over 25 plus years in the area of risk management, compliance, investment analysis, investment management, taxation advisory, and management consulting. Expertise in connecting with people and processes to arrive at the effective value proposition of business derived from hands-on experience of working in multicultural and multinational companies, experience of working in Asia, Africa, as well as Middle East, actively involved working in UAE with large corporates, SME, and individuals on indirect tax implementation advisory and transactional advisory. Contributed in development of resources with professional bodies, training institutes, and corporates to structure training, seminars, and articles. Hands-on experience in engaging with regulators and governing bodies in the space of anti-money laundering and counter-terrorism financing. This work involves understanding the strategic intent and implementation objectives of compliance. So with this, I would
Yes, Priti madam, thank you very much for the formal introduction for the speaker.
yes.
Now, Janak Bhai and Rajiv sir, now the floor is open for you. And again, I am requesting members to please remain muted and post your queries in the chat box so the speakers can take the queries as per the time permits. Janak Bhai, now over to you.
Yeah,
Janak,
good evening,
yeah, Janak.
members. And thank you, JB Nagar Study Circle, for giving us an opportunity to share our views on this very important subject, very close to our heart. And of course, and thank you for a kind word of introduction as well. So I will start with as you know, this presentation, the references have been taken from 3 laws. One law is Taxation of Corporation and Business, Federal Decree Law number 47 of 2022, which came into public domain on 9th of December 2022. UAE city, if you see corporate tax of UAE, the announcement of corporate tax was done in January 2022. The public consultation document came in April 2022. Then various consultations representation was done by various persons and authorities. And then the city law came, and it is effective from 15 days after publication in Official Gazette, which is on 25th of October 2022. So technically, the law is effective as of now as well. And it is very, very important because from the GAR perspective, which of course we will take it, but just to tell you that General Anti-Abuse Rule, GAR, is effective as of now when we are speaking also, and it is effective from 25th October 2022. So any arrangement or something which is done with a only view that having a tax advantages, which will be taken care. So we need to be very careful before we do any such arrangement or transactions. And city came in public domain on, as I told you, on the 9th December 1992. So these are the three. So one is corporate law we will be taking, public consultation document we will take into consideration, and Ministry of Finance also gave frequently asked question on the date when the federal decree law came into the public domain, that is on the 9th of December 22. There are approximately 150 plus FAQ which they have come up. Secondly, okay. So just 1 minute. Okay. So if you see how the gradually and steadily, you can see UAE has moved from so-called tax haven country to tax jurisdiction for preventing harmful tax practices and bringing tax transparency. So you see on 1st of January 2018, the VAT was implemented. On 16th of May 2018, the UAE country as a country became 116th jurisdiction to join the inclusive framework of the BEPS. On 23rd of September 2018, they drafted anti-money laundering law, which came into the effect. On 1st of CBCR, country by country reporting requirement is implemented with effect from 1st of January 2019. From 30th of April 2019, economic substance regulation, ESR, that also came into place. On 28th of August 2020, there is a regulation regarding ultimate beneficial owner, which declaration was required to be done with various regulatory authorities. And with effect from 2023, to be precise, 1st June 20, any accounting year beginning 1st June 2023, the corporate law will also become effective. So you can see that gradually and steadily, UAE has become a tax jurisdiction for preventing harmful tax practices and bringing the tax transparency. Okay. This is the one interesting observation made by OECD, where they are saying that there is substantial similarity between the technique used to launder the proceeds of crime and to commit the tax crime. And if you see, the 2/3 of the illicit cash flow involve the tax evasion. So this is very, very important observation made by OECD. And UAE has enacted, as I told you, AML compliance and framework for designated non-financial businesses and professionals, which inter alia includes auditors and accountant as well. And the responsibility is cast on us to have a proper KYC, customer due diligence, AML policy, reporting of the STR, etc. We need to be AML compliant before accepting any work. Now, as we talk today, there are two levels of taxation which are prevailing in UAE. One is emirate level taxation, corporate income tax, which basically tax on foreign banks and businesses which are engaged in the extraction of natural resources. And second is, of course, a free zone have a corporate tax holiday as per their respective degrees of decrease of the free zone authorities. So once the corporate tax law, as we saw, it is already effective as of now. So like in US, it will have a, you can say, a state tax, which is emirate level corporate income tax, and federal tax, which is a corporate tax. But as I told, as I told you, emirate level corporate tax is basically on the foreign banks and business engaged in extraction of natural resources. So when development of UAE city regime was came, the public consultation document paragraph 2.2 said laid the 4 main pillar which they will take into consideration while the city is being in place: flexibility and alignment with modern business practices, and the proposed city regime will enable the UAE to adapt and respond to the domestic and international technological, commercial, and other development. So friends, here the taxation of digital economy, nexus-based taxation, which will be a part of cabinet decision. And in the various places in the law, you will see they have mentioned cabinet decision will come out. So technically they are flexibility, they have kept that flexibility to amend the law or provide guidelines on the law by way of various cabinet decisions. And we as a chartered accountant will have to keep abreast of various this cabinet decision which are going to come. And it is something like CBDT circulars. I can relate it to CBDT circulars. So every chartered accountant will have to be keep a watch on various cabinet decisions which are going to come. Certainty and simplicity, the second principle, what they are trying, and they have also given like simplicity, international best practices is there. Like they have also come out, Rajiv bhai will take you through the small business relief, etc., which they are going to come out. And there is neutrality and equity and transparency. So question arises why UAE is introducing the corporate tax. As I told you, the UAE introduced the corporate tax basically to ensure the tax transparency and preventing harmful tax practices. Then, when the corporate tax regime will become effective, the corporate tax regime will become effective with effect from all the financial year which are starting on or after 1st June 23. So if the financial year is July to June, then the corporate tax will be applicable from 1st July 23. And if it is Jan to December, it will be effective from 1st January 24. And April to March, which is suppose India subsidiary or somebody is here, it will be applicable from financial year starting from 1st April 24. It may be worthwhile to know there is no registration deadline is given in the law. Okay, and everybody, all the taxable person have to register for the law. But as of now, they have not given any registration deadline. What is the corporate tax rate? The corporate tax rate is very specific. It is 2 rates. Either it is 0% below the income not exceeding the amount specified in the decision, which is 375,000 AED. And anything income above 375,000, it is 9%. As far as the free zone, qualifying free zone person is concerned, the corporate tax is levied at 0% for the qualifying income. What is qualifying income? Rajiv bhai will explain in detail, but as of now, it will be, as I explained to you in before, that is going to be explained or will be coming out by decided by way of a cabinet decision. So cabinet decision will come, which will throw more light on what is qualifying income, and 9% on taxable income that is not qualifying income. Here, friends, you will have to be very, very careful that in case of other SSEs, the corporate tax gives you basic exemption of 375,000. Whereas for the free zone person, there is no basic exemption of 375,000. It is 0% for qualifying income and 9% for taxable income that is not qualifying income. So therefore, even if you earn 100 dirhams as a non-qualifying income, you will have to pay tax of 9 dirhams by way of corporate tax. And 9% corporate tax is one of the lowest rate in the GCC. In Oman, it is 15%. In Saudi, it is 20%. In Kuwait, it is 15%. Qatar, it is 10%. UAE is 9%. And Bahrain does not impose, as of now, any taxation. Secondly, M&E question arises that M&E which are subject to Pillar 2 rules. So M&E will be subjected to above rates, that is 9%, till Pillar 2 rules are adopted by UAE. So once Pillar 2 rules are adopted by UAE, it may go to minimum tax level of 15%. And this has been clarified by FAQ 118 and 157. Now, let us go to what is a resident person. So resident person is any juridical person, that is company which is incorporated or established or recognized in the state, that is in UAE, including a free zone person. Things may be recognized. Why recognized word has been used? So recognize word is to capture or take care of migration of companies in UAE from other jurisdiction. So that are the thing why the word recognize has been used. Second is a juridical person which is effectively managed and controlled in the state. Friend, effectively manage and control in the state is very, very wide term, which is not defined in the law. But we can be sure it can be used for OECD guidelines on the same. And if you see, it will, in my humble opinion, it will entail the 4 major criteria. One will be the key management and commercial decisions of the company. That is a decision test that are necessary for conduct of the business, necessity test of an entity as a whole, pervasiveness test, and are in substance made. So substance test. All above conditions are to be satisfied during the relevant year. Then we will be able to say that this entity is effectively managed and controlled in the state. And here, I would like to request all of you to make a very important reading of a very recent judgment of a Reddington Distribution PT Limited. Of course, it takes care of Indo-Singapore DTA, and it is Chennai IT80 decision, which was delivered on 16th of November 22. And it really gives very good on how to effectively and manage in the state is term is defined or interpreted, and how the PE concept, which I will take over, that will also is taken care. Third is the natural person who conduct a business or a business activity in the state. If you see the natural person, as of now, natural persons are not covered, are not liable to pay tax unless they conduct a business or business activity in the state. And which are the businesses which will be covered for corporate tax, on which the natural person will have to pay the tax. This will be given by way of a cabinet decision as per Article 11, subclause 6 of the law. Then last is any other person as may be determined in decision issued by cabinet. So that is the general condition. As I told you, UAE corporate tax regime will be implemented without a parallel tax on income of a natural person. That is individuals, parallel tax. Now, but which are the income which are not covered by the tax is employment income, dividend, and investment income. As we already discussed, if individual conduct a business or a business activity, then he or she is liable to tax, and this will be specified as per Article 6 of the law. Very important two definitions which is there in the law. What is constitute business or a business activity? Any activity conducted regularly, on an ongoing and an independent basis by any person in any location, whatever. So basically, the thrust is on the activity which is conducted regularly, on an ongoing basis and independent basis by any person. And the definition of business activity is any transaction or activity or series of transaction or series of activity conducted by person in the course of the business. So any transaction, friends, here as the business activity, even a single transaction may constitute a business activity. So that is how the definition of business activity is there. So these two definition and the cabinet decision which is likely to come as per Article 11.6 needs to be kept in mind, particularly for natural person, that is individuals who will be subject to tax on business carried on by them. That is as far as a resident person is concerned. Coming to non-resident person. So which are the non-resident person? So non-resident person is a person who is not considered resident, or that is has a permanent establishment, P is the state, or derives a state source income, or has a nexus in the state. P is given definition as per Article 14. State source income is as per Article 13. Nexus will be specified in decision to be issued by the cabinet. So what is the definition of P? Permanent establishment is a place or a business or other form of presence in the state of a non-resident person in accordance with Article 14 of the Decree Law. Foreign permanent establishment basically is a place or business or other form of presence outside the state, means UAE, of the resident person. Permanent establishment refer to a non-resident person presence in the state. Foreign permanent establishment is resident person presence in other part of the world. Friend, one more thing which I would like to say, that this definition of P is aligned with the OECD Model Tax Convention. The guidance of P is provided in the OECD commentary on Model Tax Convention, can therefore be used as a reference when assessing whether a P is created in UAE or not. So that we need to, a reference can be made to various OECD commentary Model Tax Convention. So P, their law defines two P, that is, one is a fixed place of business test and dependent agent test. Fixed place of business will include a place of management where management and commercial decisions that are necessary for the conduct of business are in substance made. So this creates a fixed place P in the UAE. This is the same definition which is there, as I told you, in the OECD also. And as we have already discussed, that decision test, necessity test, pervasiveness test, substance test, based on a place of management, needs to be checked before we can come to a conclusion whether the fixed place P has been created. And once again, as I told you, recent decision of the Reddington Distribution Pte Limited in Chennai IT80, decision dated 16 November 22, is a very good 40-page decision, very good to be read if you want to understand where and how the taxation authorities are seeing that when the fixed place of management, fixed place PE is created, or the next which we are going to dependent agent PE is created. And in this case, all works except the shipping of equipment from the Singapore, all other work was done from India. And therefore, ITAT also came to a conclusion that it constitute fixed place PE in India. So it is a very important decision. I request everybody to go through it. And second is normal, a branch, office or factory or a workshop which is here, then it will create a P. Land, building or other real property. So here premises taken on rent will also satisfy this condition, and premises must be at the disposal of the foreign company. These two tests needs to be taken care. Next is, of course, the installation or structure for the exploration of renewable or non-renewable natural resources, a mine and oil or gas well, quarry or other place of extraction of natural resources. All these are covered by fixed place business test. Last, business site or a construction project or a place of assembly or installation or supervisory activity in connection therewith, but only if such site or project or etc. lasts for more than 6 months. This is very important. Lasts for more than 6 months, including connected activity that are connected at site or project by one or more related party of the non-resident person. So if these activities are for lasting for more than 6 months, it will constitute fixed place P. Usual exemption as per OECD and various tax conventions. Activities which is preparatory and auxiliary in nature, that is activities performed in preparation or in support of more substantive business activities of the foreign company, that is limited marketing or promotional activity, performing market research or attending seminar or convention. These are the activities which can be construed as activities which are prepared in preparatory or auxiliary nature, and they will not constitute fixed place PE in the state. Then a fixed or permanent place in UAE is used only to store, display or deliver the foreign company's goods, or keeping stock of goods with the sole purpose of making them available to another person for processing. This will also not constitute a fixed place PE in the state. Important thing is another, mere presence of a natural person in the state does not create PE for the non-resident person. This has been clarified in Article 14, subclause 7. Very important and in line with OECD guidelines and MLI guidelines. Fragmentation of business activities is not allowed as per Article 14, subclause 4. So you cannot fragment a fragmentation of different business activity. We just last slide we covered that 6-month period was there. So any project, so then I will say 4 months I will do under A Limited, remaining 4 months I will do with the B Limited. That fragmentation of business activity is not allowed. And double tax avoidance agreement to be referred for determination of PE or preparatory or auxiliary activity. This has been also clarified by FAQ 67. Second, PE is a dependent agent PE. So in absence of a fixed place PE, so what they are saying, the dependent agent test may be met where the a business traveler or UAE based person act on behalf of a foreign company in UAE and have and habitually exercise the authority to conclude the contracts in the name of a foreign company. So, and where a person negotiates or concludes a contract in UAE on behalf of foreign company without material intervention from the non-resident company. So this will lead to a dependent agent PE in the UAE. And second, a PE will not arise where the person carries on foreign company's business in the UAE in ordinarily course of their own business. So if I am acting as a distributor of various suppliers or manufacturer, so this, then I will become independent agent. So this so-called independent agent exclusion would only apply where the person does not work exclusively for the foreign company and is truly legally and economically independent from the foreign company. Now this needs to be documented, proved and established to come out of the dependent agent PE test. And once again, if you read the detailed judgment of Reddington Distribution Pte Limited, they have come to a conclusion that in that case, Indian operation carried out of the Reddington Distribution Pte Limited satisfied both the PE tests. One was fixed place PE test and even dependent agent PE. So they said you are covered by both. So that decision is very important and very reasoned one decision, which I request for a good study. It makes very good study of the law. So it is important to analyze the agent and principal relations. Now, another important is a UAE source income. So UAE source income earned by a foreign person that does not have a PE in the stay in the UAE will be subject to withholding tax at rate of 0%. Friend, this withholding tax at 0% is very, very important because 0% rate is also a tax and may be classified as subject to tax for various tax these things. Now, UAE source income, there are special provision defined in the law. So if the payment is attributed to PE of UAE of a PE in the UAE of a foreign company, so that will be also covered. Income is derived from activities or contract performed in the UAE, asset located in the UAE, or rights used for economic purpose in the UAE. Everything will be considered as UAE source income. However, FAQ 68 and 69 have clarified that merely earning UAE source income will not trigger city payable or require foreign entity to register and file tax return, as same are subject to 0% withholding tax. Friends, moment withholding tax becomes 1%, then all this thing will undergo a significant change that we need to keep in mind. So income shall be considered, Article 13 is saying, income shall be considered a state source income where the income is derived from a resident person. That is where the payer is a resident person. Second is where it is derived from a non-resident person and the income is received has been paid or accrued in connection with and attributable to PE of a non-resident person is in the state. So UAE is the payer, and where it is otherwise accrued in or derived from activities performed or asset located or capital invested, right use or services performed or benefited in the state. Then Article 2 of the Article 13, it is giving a various list of income that will be considered as being sourced from UAE. Friends, it will be worthwhile to know that FAQ 75 very specifically and categorically says that this is a non-exhaustive list of income that is considered as being sourced in UAE. And which are that? Let us go through income from sale of goods, income from provision of services, income from movable or immovable property in the state, income from disposal of share or capital of a resident person, any income from use or right of any intellectual or intangible property. Now this H is very important. Interest that meets any of the following, any of the following. The loan is secured by movable or immovable property located in the UAE. The interesting scenario may be arising where the lender is outside UAE, borrower is also outside UAE, but the property is located in the UAE. As per Article 13, this interest earned by the lender will be considered as a state source income. So this is very interesting, which they have come out with. Or the borrower of the funds is a resident person or borrower is a government entity. Then also the interest, even the lender is outside UAE, but this interest income will be considered state source income. Similarly, insurance or reinsurance premium paid in following instances, that is insured asset is located in UAE, or insured person is a resident person, or insured activities conducted in the state. That is normal. This we have covered. 11.6 also we have covered. So now, who is considered as a tax resident of UAE? So friends, if it is a legal person that is incorporated in the UAE will be taxable in UAE on their worldwide income. Natural person, individual, any natural person who is engaged in business or commercial activity in UAE will be subject to tax in UAE. However, as per law, it will be limited to the income earned from their business activity carried out in the UAE only. And the exception, as we already discussed, Article 11, subclause 6, will list out various businesses or business activities which will be subject to tax in the case of a natural person. As far as foreign companies are concerned, a foreign company may be treated as a resident person if it is effectively managed and controlled in the UAE. We have discussed in detail what needs to be checked for effectively managed and controlled in UAE. Say, for example, a company which is registered in BVI, however, the director, shareholder, everybody is in UAE, then that BVI company income will be subject to tax in UAE based on this foreign company effective manage and control definition, and this company will be taxable in the UAE on their worldwide income. So it is a residential based taxation which is being followed here. And when the income earned from abroad is not exempt, of course, the foreign tax credit can be taken as a credit against the corporate tax payable in UAE on the relevant income to prevent, of course, the double taxation. Friends, since withholding tax as of now is 0%, so there is no requirement to file TDS return, as we call it in India, or withholding tax return as of now. That brings to end of my first session of presentation. And are there any questions which needs to be taken by me?
Nothing in the chat window, Janji.
Nothing in the chat box as of now. Yeah. So, Rajiv bhai, you can take over from here. Thank you. Thank you. Thank you. I will stop my screen share. Yeah.
Thanks, Janji, for putting the context. And I think the most important part which you shared very rightly is why taxes are coming to UAE. So if we are having that perspective right, a lot of things we can understand what's happening and why it's happening in Europe. One of the things which we keep talking about is UAE coming up with the taxes on account of collection of funds? Answer is no. That's a byproduct. There is a lot more reasons and behind that which is getting impacted. So when we talk about the taxes, I think there is always a comparison comes as how India and how UAE is treating differently and how this will be treated differently as we move along also. I think one point which I will refer here is it's not a different story. It's how different markets are. So from a UAE perspective, I will say here the law is not complicated, but yes, the way businesses are done are little complicated. This is where it comes into. So headline points which we just run through with Janaji is natural persons are not taxable. That's a headline story. But is it fact that no income tax will be there or no corporate tax will be there for people who are doing a business? So answer is no. Anyone at an individual capacity also, if they do a business, it will be subject to taxes. So that is where the difference comes in, and we keep giving some illustrations and examples how the difference is treated. Is a transaction treated as a personal investment transaction or is treated as a business transaction? It's a very open and gray point, which always need to be looked at. Moving ahead to where we stop. So there is a very nice principle which has come up specifically for two sections, which is a transparent principle. The law has come with two articles which says that if there are any kind of a unincorporated partnership, which is there in a structure, that means we don't have a listed company or a registration. Before I talk about a registration and listing, I'll just give us a broad snapshot of. In UAE, you cannot do a business unless you have a license to operate. That's the first part. So if you want to do a basic activity as a teaching also or as a coaching also, there is definitely a requirement to obtain a license to do that activity, which can be a freelance activity, which can be a full license activity. That's a different discussion, but there is definitely a requirement of a licensing. So that's the reason there is a lot of sections you will see which talks about incorporated companies and unincorporated companies. Now, unincorporated companies are logically not allowed, but there can be instances where two incorporated companies join hands and do some project collectively. That's one part. Second, there are instances where people can buy property. So when you're buying a property, maybe 4 or 5 people come together and they say, okay, we are buying a property jointly. Now they don't have a company or a structure to buy that property. So that also classified as an unincorporated entities or a structure. So what the framework has come, the framework is as simple as they are talking about a transparency structure. So whenever there is an unincorporated partnership, they say just remove the partnership, unincorporated partnership from the layer, and whichever people are behind that, those people or those entities or those structures will be taxed. There are some conditions which are being brought up, and those conditions has to be complied. So that's a headline story. Whenever there is an unincorporated partnership, just remove the unincorporated structure, and whatever is behind that will be taxed accordingly. So this is a broad structure which is brought up, and it talks about a lot of compliance from an execution perspective, how you can claim the expenses, what kind of a ratio analysis has to be done for claiming the expenses, and that's where this point comes into play. Similarly, they came with one more exemption or something transparency rule, which is on a family foundation. Now, U is an interesting market where something equal to a trust. So if I just do a like to like, I'm not just doing a comparison. If I do a like to like, wherever the foundation is there and can be relate to how the trust operates in it. The difference is in UAE, there are structures in the foundation which are incorporated foundations. So that's the reason it talks about whether it's incorporated or unincorporated. Both can look for, but this is subject to approval. That means you have to file an application saying that we want to use a transparency structure, and the foundation has to meet some condition to get a transparency rule benefit. That is, they have identifiable natural persons or the benefit of public benefit interest of both. So technically speaking, in this case, then foundation cannot have a corporate structure that rules out. So if you have a corporate structure, you cannot come into this exemption. The principal activity is technically the passive investment is what it talks about. That is to receive, hold, invest, disburse, or otherwise manage assets. So they are more a passive investment company. No active business technically is done. And the family foundation does not contain any activity that constitute as a business or business activity. So if you look at point number B and C, they both relate to this foundation can only have a passive income, no active income. So we all know what is active and passive income, but just for the benefit of, if you do any business and generate revenue by acting or by doing some kind of a role, then it becomes an active income. But when you receive something passively, like rental income, interest income, royalty income, these are more or less a passive income which are being classified as. So this is where it is very clearly identified how these investments are held into. And the main purpose of foundation is not to avoid the corporate tax. So that's also put as a condition. Now, if you see, this is acting as a GAR principle also, and putting up to the condition how this foundation structure should be implemented. And overarching principle is coming to all the sections here where it says that whenever ministerial decision comes into, they will specify more decision also on how this family foundation will be working. So if you look at Article 11.6 or Clause 6, which Janakji has also explained, so this is where the similar principles applies into in the family foundation structure also. But just a matter of re-pointing it out. It's not by default. It's based on the application to the authority, and authority, that means the federal tax authority, is going to accept it. Then only this transparency structure can be adopted. Now, again, if you do something which is not in line, it can go back. So monitoring of the family foundation will be conducted by the tax authorities. Those are standard points which are part of the section. Now, one more interesting Article 21, which came with about a small business relief. So it's something similar to if someone is not earning an income of more than threshold, which is 375,000 dirhams, approximately, if I just put it plus minus 85 lakh rupees. So if that's the income you are earning and you are not doing something which is above the threshold, that means does not exceed the threshold of 375,000 dirhams, which is 85 lakh rupees, then you don't have to be bothered about the documentation part. Now, what is the documentation we're talking about? There are a lot of clauses, there are a lot of sections which talk about transfer pricing, documentation to be maintained, related party transactions to be maintained. So in this case, there is going to be a small business relief which is coming up. Okay, you guys are small business. You maintain these 3, 4, 5 records, and that's it. You don't have to get into extensive action into what required from a corporate tax perspective. Again, there are some provisions that it should not apply. That means you are not having exempt income. You are not taking any relief, which is defined in the chapter 8 of the decree law. That means you are not taking any benefit extra and over and above what is there. So if you are taking any extraordinary benefits, like any extraordinary category, then this section cannot be applied. But it's a quite an important section. Just to give you some broad framework, in UAE, approximately 400,000 VAT registered people are there. That means they have a taxable turnover of more than 375,000 dirhams. So top line is 400,000, but there is a good segment of client who does not have a taxable income. They do maybe an out of scope transaction, or they do business from free zones which are not covered. So if you put them also together, maybe 500 to 600,000 is what we are talking about. And small business really takes out a larger population out of the corporate tax story in a broad way or in a compliance way. So that's an important section, I will say, and it gives quite a benefit for a small businesses to see how they can even have implementation. But definitely, having a book writing, having a proper books of accounts, ensuring that whenever regulator comes and you prove that your income is always less than 375,000 dirhams, it's definitely a requirement to be maintained. Now, there are interestingly some exempt incomes. The logic which I think the federal tax authorities is using from a UAE perspective is they don't want to tax something double. So they don't want a double burden to come into any kind of a tax structure. So first thing what they said, if you are earning a dividend from any company, which is a judicial person, that means a registered person, who is a resident person from a UAE perspective, then we're not going to charge any dividend tax on that. So that means If you receive any dividend from a company which has already paid taxes, there is no point in charging again a tax. So there's no point of double taxation which is coming in this. And there is a good point on participating interest. Now, what the law says, if you are having a controlling interest and a shareholding interest and a profit interest of 5% or more, and the foreign jurisdiction is paying the taxes of 9% or more, then remove this income from a tax perspective. So example, if there is a holding company in UAE which receives a dividend from a X country, and you're holding more than 5% of the stake. When I say stake, it's not only shareholding, it's a shareholding plus control plus even the profitability concept. So if all the three conditions are met, you're receiving the income, and you're receiving the income from a country which is already taxed 9% or more than 9%, that is what is UAE headline rate, then also we are not going to tax it. So this is where the participating interest is a very important part, and it maintains a good status for a holding structure in UAE. So that's where it comes into. Second, any other income from a participating interest, which is what I refer to as a dividend. So it can be other incomes also, capital gain or other factors which comes in. So participating interest income is being exempt or categorized as not going to be taxed from a UAE perspective. Income from permanent establishment that meets the condition of Article 24. So if a foreign permanent establishment that meets the condition, so there are clauses which are specified in Article 24. If you meet, then also it will not be taxed. Last point is they have categorically defined, or you can say excluded, some of the non-resident incomes, that is income derived from a non-resident person. One is who is operating aircraft or ships in international transportation. So there are certain conditions. So if you are part of international aircraft or ship operations and you have a P in UAE also, although being a non-resident, still will not be taxed. So these are very specific, industry-specific actions which are being overarching principles applied from a law perspective. We talked about participation exemption. So these are headlines, or you can say these are broad elements which we talked about. As I said, 5%. And then there is a clause of that you don't have an exempt income of more than 50%. So that's where it goes into. So that's where the participation exemption comes and plays into. You need to maintain those 5% and above for more than 12 months, and all those conditions has to meet. So if you are participating exemption, you have those 5% clauses, you are good to go. No taxes will be applied on even the holding structure. So that's a very important part, just a gist of what we talked about. Any domestic dividend earned from a UAE company, including dividend paid by a free zone person that benefit from 0% corporate tax regime, will not be taxed when you receive the dividend. Dividend paid by a foreign company and the capital gain on sale of shares. So UAE shareholder must own 5% of the subsidiary, and the corporate tax is there in the foreign subsidiary of more than 9%. Again, will not be subjected to tax. Now, capital gain on disposal of share has some more intricacies which need to be looked at. Again, as we referred to, this is more coming from a public consultation document. We are still awaiting for a corporate regulation or a ministerial decision which will tell us more on how these capital gain stories will be looked at. So far, if a capital gain is there, free zone company must own at least 5% of the share in the subsidiary, and then capital gain will be out of the preview or picture. So that's what is coming in. And again, we have to look at, even for the free zone, that whether it's being taxed or not, or a mainland, whether it's taxed at 9% or not, to look at a headline, whether it's going to be subject to tax at a 0 rate or subject to tax at a 9%. Some of the interesting thoughts which are coming up, we have seen this in the practical scenario also. UAE holding company has a BVI company, and BVI company further holds a UAE company, which is subject to 9%. So it's basically a round robin transactions or capital movement transactions which are there. In this case, UAE shareholder company must own at least 5% of the share of the subsidiary company. However, if I talk about a BVI, just to give a perspective, it's not subject to corporate tax. Then should it be taxed or not? As per current structure, it is coming at will be taxed in UAE because the BVI does not hold any taxation. Again, Matter of fact, we need to again wait for an executive regulation. Will they talk about a pass-through taxes or not? We need to look at, but that's a loop or that's an open point which is coming up from the existing law framework what we read into. We are talking about some open points also which are important to review and see. I'll hold here. If there is any questions, maybe to address that. Otherwise, we can go to the next topic of free zone, which is interesting talked about discussion, I'm sure, from India side also.
Rajiv, no questions up till now.
Perfect. So I'm sure maybe after the session is over, then you will have a lot of points to talk about. Going to free zone, I'll just give a first an outlook of what is free zone and how it is. I'm sure a lot of people understand that, but it's important to maybe pick up those points as part of the conversation also. UAE has interesting structure. So they have created a free zone, which are different types of free zone. I will talk about that. There are financial free zone, there are non-financial free zone, there are gated free zone, there are non-gated free zone. So free zones, what is the objective and why the free zones came into existence? So free zone were considered as a location. If I just compare from an India perspective, SEZs, taxes, which are there are no taxes technically applied in those free zones if they're operated within the free zone. So the ministers have decided in the previous legislation stating that there are tax holidays being provided to these free zones by giving a clarity to people that if you do business today, it's not that tomorrow we're going to put taxes. We are not going to put taxes for X years. Now that X years is something which is different for various free zones. That's what we need to look at. I just gave a comparison for two financial free zone. In one of the financial free zone website, we find that 50% of zero corporate tax for which is downloaded as of December 22. And in another website, it says 40 years. So now there is a difference between the tax holiday comes into play. Now, till what time this tax holidays will be there? That's what the question arises, and that's where the ministerial decision also. They said that every free zone will be first judged whether they are a qualifying free zone person or non-qualifying free zone person. Now, qualifying or non-qualifying free zone person will come from the ministerial decision, and based on all the initial legislation or regulations which are being drawn from a free zone perspective. Now, UAE economy is an interesting economy from that perspective. There are enough of free zone. I'm just touching across indirect tax VAT also, so that you can relate to. And there is a lot of reference being given, especially on the free zone, for direct and indirect tax. Both were touched across to give some kind of a linkage. From a VAT law perspective, that is value-added tax, which is implemented in UAE in 2018. There are enough of free zones where if you bring the goods inside, you process, there is no VAT implication comes into play. These transactions are technically considered as out of scope transactions. With little bit of more detailing, when we go, we'll find it's not as simple as that. But a headline information is any transaction done within those free zone are not subjected to VAT. So that's the same premises that we use from a corporate tax perspective also. So in indirect tax, they have classified as designated and non-designated. In corporate tax definition, the term is coming as qualifying free zone and non-qualifying free zone. So a qualifying free zone technically should meet the conditions. One, maintain adequate substance in the state. State being referred here in UAE as a UAE, United Arab Emirates, that's a country. So should have a substance. Now the substance word is quite important from a UAE side, and we have seen there is a special law which has come on, which is economic substance regulation. Has enough of people, resources, space, and manpower, and activities or assets which are required to generate the profit what they're generating. So there are instances being noticed where people have parent companies or subsidiaries in various locations, other location than UAE. I'll just take an example. In next country, we have 1,000 people. In UAE, we have 3 people. In where the 1,000 people are based, The total profit is $100,000, and where three people are based, the total profit is $10 million. Now this does not gel well. So that's where the substance requirement came, which is more highlighting from a base erosion profit shifting perspective, BEPS framework, or you can say connect with the OECD AML framework, where the substance is getting judged and tested, whether people have the right substance, the location have the right substance or not. Now, based on the business we handle. So that is where it comes into. Second, there is qualifying income. Now, what is the definition of a qualifying income? We have to go to the public consultation document, because they have not mentioned that as part of a legal framework or law as we talk. Has not elected to be subject to corporate tax under Article 19. So they're given one condition also, a very interesting point, where someone can say that, okay, I don't want to be a qualifying person. I just want to pay taxes on a normal way. Now, why someone will like to pay taxes on a normal way? That's also interesting fact, and can do it. We'll come to that also in the further slides, and complies to Article 34 and 55, which is more a transfer pricing and related party transactions. So if these conditions are met, then you are good to go, and you can call yourself as a qualifying free zone person. And the last condition, as I said, is there this perspective, if they supersede any other specific action. Now, if you stop at any time or fail to meet the condition, then from the beginning of that tax year, you are not considered as a qualifying free zone person, and you move on. Now, what is article, as I referred to, from a tax perspective, I'll just go to a very simple question. 9% on taxable income that exceeds the amount specified in a decision issued by cabinet ministers. So should we tax anything more than 375,000? Answer is no now, because and this 375,000 is not assumed now. Cabinet decision has come and it is being clarified. So that's not the case now. Now we have two category of income, which is being covered by Janakji, but since I'm talking free zone, it is going to be important to look at. In general, you have a threshold that 85 lakh rupees. There is no taxes beyond 85 lakhs, you pay the taxes, but that's not the same for the free zone. For free zone, if you are qualifying income, then you pay 0% taxes. If you are not qualifying income, then you pay 9% taxes. Even if you have 1 dirham of non-qualifying income, there is no slab available. So you can take a choice whether as a free zone also you want to go into the section clause 1. You have a choice available with you. So if you believe your income is let's say 50% qualifying, 50% non-qualifying, in that case, and your total income, let's say, is 400,000. In that case, you end up paying taxes on 200,000 at 9%. Or alternatively, you can take a choice that I will pay 375,000 at zero rate, and only for 25,000 I'll end up paying 9%. So that's the conditions which are being provided. Now, again, we of choosing of which clause 1 or clause 2 to take can be taken every year, or once I take, I have to freeze for a couple of years. We need to look at that from a regulation perspective. That's not very clear how this will be applied to. So headline rate is 0% for a free zone, but definitely there are non-qualifying income which comes into, which I'm going to take up as a detailed section also to give some clarity. So snapshot for a free zone person, you have two category of income. It's not a slab. It's a two category of income, qualifying and non-qualifying. Whenever there is a qualifying income, end up paying 0% taxes. Whenever there is a non-qualifying income, you end up paying 9% taxes, irrespective of what is the total value. So can we be, as I said, article, you can take a choice based on Article 18, what are the clauses are mentioned, which we talked about. Now, whether this will be revocable, irrevocable, we need to wait and look at from executive regulation. That's where we'll get more clarity on. Generally, if you see the top line from a free zone perspective, it is said that free zones are not permitted. to do any business with the mainland unless they obtain an appropriate license from a local authority. So that's a general condition, or that's a theoretical condition which is mentioned. But there are instances and there are cases we have seen where free zone companies are dealing with mainland. Now this need to be a little bit revisited, how this can be worked in. Now I'm going to connect the law and the public consultation document, because this is a little bit open so far, because we have not seen the executive regulation apply to. And we are picking up specifically PCD. If you see public consultation document 3.28 refers to a very interesting point where it says 0% corporate tax on income earned by free zone. Now there are two words which are used. I think that's where the interpretation comes into. A free zone person can benefit from 0% corporate tax rate on income earned from transactions with business located outside the UAE. That means if you do any business with outside UAE, which is technically an export transaction, then you can avail a 0% corporate tax. Now here the word is transaction. And the second point, that is clause B, talks about from a trading with businesses located in the same or other free zone. Now they have removed services, is the interpretation which is coming up in this section. That means what will happen to the service transactions if are done within the or other free zone. So as per the understanding which we are getting from a PCD side, it will be, and it may be corporate tax. So that is where it will change into. And they have come up with one more exception, which is on financial foreign market. So if it's a regulated financial services directed at a foreign market, then also it's a 0%. And typically we have two centers, which is ADGM and DIFC, which are financial free zones. And this section is more or less diverted towards that clause. So here the service is coming as an open point. So any income earned from a service perspective within the free zone or between the free zone will be subjected to tax. And I'm going to dwell a little more on this point as we move along, because that's where a lot of action, a lot of implications are there from a tax perspective. Now, what happens if a free zone person that has a branch in the mainland in UAE? So I may be a free zone company and I have a branch in UAE. Technically, branches are considered as extension, but here in this case, law has given some benefit. They said you maintain separate books. You can have a regular corporate tax on mainland income, and a free zone can still benefit from a 0% corporate tax on other income. So that means there is a clear segregation of books is becoming important if you have two jurisdictions being attached, either as part of an entity or a branch. So that is need to be looked at. So important, again, book writing, accounting work, apportionments of expenses is a critical activity which will come up. So apart from tax, I still believe accounting and how the records are maintained is becoming more important in the prevailing days now. Again, one more scenario, what if a free zone person transact with mainland UAE, but do not have any mainland branch? Now, in this case, one specific point which we talked before also, if you want a passive income, then it's fine. It will still be classified as 0%. So it may have a benefit of a 0% taxes, although you are dealing with a mainland. But subject to the income is a passive income only, nothing to do with a business or active income. So these are typical scenarios which are coming up and looked into. What if we have a group and the transaction between free zone person and other group companies? So again, very interesting interpretation which was there in the PCD, public consultation document. For free zone, you can take 0%, but for mainland, don't claim those as an allowable expenses where you make the payment to the free zone. That means it's not allowed as a deductible expenses. So what will happen? Although you're taking a benefit in the free zone, you are getting taxed in the mainland. So that's again one point of tax which is coming up. So you can transact with a group, no problem, but any payment you made to a free zone person will be subjected to tax. That means you will not allow this as a deductible expenses. So these are quite intricate points which comes into. And one very interesting, as I said, there is a lot of linkage coming up between direct and indirect tax. One is which is again coming back from a from a corporate tax perspective. They said there are VAT designated free zones. So in case you are dealing with a VAT designated free zone kind of a structure and you sell goods to mainland, now who is importer on record, that will determine whether the indirect tax and the corporate tax will apply or not. So technically speaking, they consider the free zone as the international water. So if there's an international location or international water, anyone who comes in the international location, buys the goods and moves, pays the import duty and bring the goods in UAE, it's not the review or it's not a problem of free zone. So they're still considered as a 0% in that case. But if the importer on record becomes the free zone company, then there is a problem. So that is where the transaction goes into a very different tangent. Looking at little more detail, I think this is a little bit of a high level. So I'll pick up an example also to see how those transactions can be looked into. Now, this is where the public consultation started. Quite a worrisome point for a lot of people, which says that if you have any other income from a mainland source business, then the whole income of a free zone got disqualified at the time of public consultation, but it got replaced. Now, this is where the major change we have seen from a consultation document to the law perspective. They said, no worries, it's not any income if you receive, you will be subjected to the whole income tax, whole corporate tax. That's not the case. You differentiate between qualifying and non-qualifying. We only tax you on non-qualifying income. For qualifying income, you still get a benefit of. So these are the headlines or the top points which comes from a tax perspective. Again, as I said, the challenge is going to be apportionment, how those expenses will be apportioned. It's easy always to portion the income and align the income to qualifying income and non-qualifying. But there are common expenses. Wherever there are direct expenses, it's not a problem, but wherever there are common expenses, how you allocate them, what kind of a apportionment method you use, that becomes really a challenging activity. I'll take a storyline. I think that's the most easiest way to align and connect with the dots from a tax perspective. The story goes as there is an African continent. We found some good coffee beans, and those were imported in the free zone. I'm talking about designated free zone to make it convenient from a direct and indirect tax perspective. I'm using both for the benefit of the discussion. So this is the UAE map, and you can see the goods have moved from Africa continent to UAE. Technically speaking, should be, in this case, what happens is UAE designated zone, that is a free zone company purchases coffee bean in bulk from Africa continent. Goods are purchased from the rest of world to designated zone are held in the customs suspension. Now, the most important point comes here is a customs suspension. That means goods have not crossed the custom border. That means custom duty is still not paid. So these are still considered as an international transaction held in the geography of UAE, but from a trade perspective, it is considered outside UAE. That's a headline point which we need to look at. So in this case, if you do this kind of a transaction, it's completely a qualifying income and will be subjected to 0% corporate tax. Now, the story changes as now this UAE designated zone processes these coffee. So they roasted, toasted, and converted them into a small sachets within designated zone, and final product of 500,000 packets of 50 grams were made. Again, if you see, these goods are still under the customs suspension. That means no custom duty, nothing is being cleared. So from a geography perspective, again, and for the benefit, I'm repeating, from geography perspective, these goods may be in UAE, but from a tax perspective, these are held outside the UAE. This case also, there is no indirect tax and you end up paying no corporate tax also, because this again is a part of a qualifying income. Now, again, I have to trade within UAE, outside UAE, and all that factors. So I'm using some further example where I transferred from one free zone to another, which is both are designated zones from a indirect tax perspective also. So if I transfer these beans, what happens is I picked up 100,000 packets and sold it to another free zone. Again, I'm transferring under the customs suspension. That's underlying information I'm providing. Still, since these goods are still within the customs suspension, although these goods are traveling within UAE, traveling between the free zones, touching the mainland, no matter, this will still be outside the purview from a indirect and direct both tax perspective, and still qualifying income will be 0% in this case. So it still fall into the qualifying business. Now, as everyone is using a headline statement that all the free zones are out of the tax, so I want to break that thought process. Now, in this case, what happens? A UAE designated zone company is having a coffee shop also. So it's a retail outlet with license in food court in designated zone. So now the principle from an indirect tax perspective on a headline comes into, if something is ready for a consumption in UAE or used for a consumption in UAE, indirect tax will apply. And similarly, the corporate tax also is intending to take the same route. And in this case, what happens? I sold from a company which is still holding the goods in the customs suspension to a coffee shop, which is also in the free zone. Interesting thing, it's not going to be outside the perspective. It is coming into indirect tax space, and this transaction, although it's done within the free zone, will not be a qualifying income and may be subjected to 9% tax from a scenario perspective. So important part, we cannot always say that every transaction in the free zone is subject to 0%. No, that's not the fact. You need to look at the intricacies of the transaction. Headline information I can talk about, anything which is under the customs suspension, maybe.
अपने को अपना जो काम खत्म करना है, documents अगर साथ में तो कभी भी discussion नहीं. You never use your travel time. Never. And what we do is हमारे advantage.
So this is where the storyline, or you can say that the scenario differentiation comes and plays a role. Taking further the last scenario, what happens if I sell those goods to India as an export? Now, in this case also, since the transaction is happening under the customs suspension, I don't need to pay the custom duty because I'm not at all bringing those goods in UAE. Still, this is classified under the qualifying income. So the headline statement, anything which is non-custom paid may translate to a non-VAT, non-value-added tax, and again, not applicability of corporate tax also. So who is importer on record and how the importer on record comes into play becomes an important part. So I'll give a pause here. If there is any questions, we can pick it up. Otherwise, maybe Janakji, back to you for picking up further pointers.
Rajiv, you want to continue with the tax group and tax losses, or how we
Not at all. I want to give a pause there for any questions right now.
No, there are no questions. There are no questions in the chat box.
Okay, perfect. Perfect. I'm back with some other interesting factors which are there. Perfect. So calculation of taxable income is again something at a high level, what is being picked up from the law perspective and also the PCD. It starts with as simple as financial statement, profit and loss. So the legal framework says that if the books are maintained under the international accounting practices, then we can go from there. So IFRS is one of the acceptable standards which are being used. So if books are made under the IFRS, start with that point and then start moving into what can be claimed and what cannot be. So there are two revaluation reserve or unrealized gains and losses which are talked about. One is a capital item and one is a revenue item. A capital item, if you have done any adjustment, positive, negative, just remove from the calculation. Revenue item, that means any revaluation you have done for or unrealized gains you have realized for the stock or a revenue item, keep it there. Don't remove it from the financials or from a tax perspective. So just to give an example, if you've done a revaluation reserve of a property and you have added up the value of the property from maybe $10 million to $20 million, just remove that additional profit, which is being calculated from the calculation perspective. It is taken into the P&L. So that's what it comes into. There are certain exemption incomes. Since
Rajiv, your screen is not shared.
Oh, just give me a minute.
Sorry to.
No, perfect. Yeah, hope this is fine now.
Yeah, now it's fine. Fine.
So I'll take it up back again. So there are, I'm just showing how the broad calculations are there. So we talked about accounting. So unrealized gains and losses are of two nature, capital and revenue. So anything to do with capital, we have to readjust it. That means it is not allowed from an accounting profit and loss perspective. But when it comes to a revenue, it is to be taken care. So as an example, I just look at a typical example of a 10 million property, which is being revalued to 15 million. So in this case, you have already added a profit. If you have added a profit in the accounting P&L of 5 million, then you can reduce that profit and do a further calculation, because that's not to be considered. Now, subject to unrealized gain on losses on capital item are not taken into account while calculating taxable income, but you have to keep one calculation or one understanding right also. The book value should not change from a tax perspective. So if tomorrow, if you sell that property, the sale profit has to be based on the base value that is before the revaluation was done. Whereas from a revenue perspective, it has to be taken into account by calculating taxable income. There are certain exemptions being provided where these are exempt incomes, which include, we talked about expenses, deduction limitations are there, which is on account of expenses incurred in relation to exempt income. So if you have any exempt income and there are expenses incurred related to exempt income, just remove that. There is a limitation on interest which can be claimed. There is a cap of 30% of EBITDA. So earning before interest, dividend, and depreciation and amortization. So that's a very clear. So if you have anything beyond 30%, that is not allowed to be taken in the specific year, but you can carry forward. So interest cap is there. You cannot claim more than 30% of EBITDA. Limitation on deduction of interest on loan obtained from RP in certain cases. So if there are RP transactions, you have to look at the fair value and then come up into the percentage. But from an interest perspective, the ultimate cap is 30%. So everything has to be done within that. Entertainment expenses, any expenses on a flat, it is disallowed 50% if it is for the business purpose. If it is not for business purpose, there is no point in deliberating that. But if it is for the business purpose, then 50% is only allowed. Penalties, fines, any recoverable VAT, donations which are not approved by the cabinet will all be adjusted back into the income if these are there. RP transaction adjustments is a standard one. India knows far better than what UAE is going to learn on this topic. So any kind of adjustments on the TP adjustments has to be looked into. Losses limitations. So there are losses limitations also which are being proposed. We cannot claim a prior period losses between the companies. But there are interesting factors which are there for loss adjustments, which we talk about. One is losses carried forward. That is 75% of the taxable income you can only use for adjustment. You cannot do beyond that. There are two interesting clauses which are there: loss adjustment within the group and loss adjustment intra-group. Now, if you are having two companies and there are some kind of a linkage, which we are going to talk about in the further slides, you can still claim the losses of one company to another company, subject to some conditions being met, which we will look at in this section, which we are going to talk about. So interest, we talked about 30% of the headline. That's what is coming up. Now, for the purpose, they have removed some of the entities or some of the person for which this 30% clause will not apply. So that is for bank, insurance provider, a natural person undertaking business or business activity in the state. So for individuals, that 30% cap is not there. Any other person which the minister decision may define. So that's where it comes into. Now, I'll jump into the interest reduction rule. So that's a high level cap which I'm giving into 30% of EBITDA fixed amount we may expect. So that's where it's coming from a ministerial decision perspective. So we are expecting that can be a fixed amount also, that up to this amount you can claim it. If it is not, then test the waters for 30%. So that's where it's coming up to. There can be a special method, which is a consolidated group to apply different interest capping rules. which we are going to look at. I'll just give you a perspective on how the grouping can be adjusted into. Again, similar principles, related party interest calculations, TP pricing methodology has to apply whenever there is an interest principal rules coming up. Certain categories which are exempt, we talked about those deductions. Entertainment, we talked about 50%. Now this can be any expenses which are related to business. So that's the most important part. If it's not related to business, anyway, take it out. So you will not be able to claim it. There are certain list of items which we talked about, which is donation, fine, bribes, or any illegal fund payments you have made. Anything which is not accounted for is, or you cannot substantiate it, is a point. Now, as we talked about, UAE is quite regulated on how the licensing is there. So a lot of time, what happens? The businesses hire the freelancers. Now, if you hire a freelancer who does not have a permit, or does not have a freelancing license also, then we expect those expenses may also not be allowed, because there is no legal structure for those entities to claim their expenses. So that's where it comes into. Now, from a loss relief, we talked about up to 75% of taxable income for each of those future periods. So first test comes in you can carry forward the losses, no problem on that. The amount of loss used to reduce the taxable income of any subsequent period cannot exceed 75%. So you can only adjust up to 75%. Anything further is there, you can carry forward. So there is an infinite period, indefinite period. So there is no period being defined so far from a law perspective till what period the losses can be carried forward. Now, a taxable person cannot claim tax loss in case losses incurred before the commencement of corporate tax. So anything before you are eligible for paying the taxes anyway, it's a commonsensical thing, but it's a law is always plays on what's written in the frame also. Losses incurred before a person becomes a taxable person, that means before he has come up and qualified as a taxable person from a law perspective. Or losses incurred from an asset or activity, the income of which is exempt. So anything which is under the exempt category you cannot treat it as a taxable income. So losses can be carried forward to the subsequent year and can be adjusted as we talked about. Limitations on tax losses. There are instances where tax losses can be carried forward. We talked about, now in this case, when you carry forward the losses, or when you do some kind of a restructuring, it is important to see that ownership should not change, or the people who are controlling people should not change. So headline statement I just say here is not allowed to buy losses for future profit. So if the company ownership is changing, or the model is changing, or the business category is changing, then also there is a problem, and you may not be able to allow to claim the losses. So for the continuity purpose, some of the condition, that is 50% of the business ownership should maintain, has to apply. But they're given exemption for a listed company. So if there is a listed company, this clause will not apply. That means you can claim, you are not required to look at whether the ownership is common or not. Last section on a tax group side, again, interesting point they talked about. You can bring up multiple companies and form a single tax group. Now, for forming a single tax group, certain conditions has to be met. Point number one, that is 95% of the common ownership or a shareholding should be there. Neither the parent company or the subsidiary should be in the category of a 0% corporate tax. And the third condition is all companies should have the same financial year. So if these three conditions are met, you can apply for a tax group. Now, again, this is an application method. When you apply, authorities will approve, and that's how it will come into. Just giving a quick example, if I have a parent company which is in mainland, I have a 95% subsidiary which is in mainland, I have a 40% subsidiary in mainland, I have a 100% subsidiary with 0% corporate tax, maybe in the free zone, and I have a 100% subsidiary with standard corporate tax. So if you look at, I cannot bring these two companies, that is first company, which is 40%, so less than 95%, I cannot bring it as part of a group. And I cannot bring even a 100% subsidiary, but a 0% corporate tax as a part of a tax group. So for the purpose of tax group, only three companies qualify, and that need to be looked at in addition to it.
you need to see the financial year is same. So UAE is in a unique proposition where every company has a choice of using the financial year what they want to based on the registrar office. So it's easy to change, but that's also a procedural part. If you want to become a tax group, need to look at whether all the companies are following the same financial year, all the companies are having 95% common interest, and none of them is part of the 0% category or exempt category. So again, looking at a financial year, just a quick one. So if the financial year is not common, you cannot bring it as a part of a tax group. So that's where it comes into, just to give you a perspective on that. So once formed, a tax group is treated as a single taxable person. So bring all the companies together and this is a single person, and then you treat them as a single person for all assessment purposes. So any intra-company transactions are ignored, and that's how you are going to look at from a tax treatment perspective. Now there is something interesting which is there, which is on account of transfer between the member groups. So now here the conditions are interesting. If you transfer any asset or liability between the member of a group, now what are the conditions which are there, which I'm talking about? I'm not talking about a tax group which is being maintained. I'm talking about a group which is from a structure perspective. In this case, you can transfer the assets and liabilities subject to conditions are 75% of the common ownership. It comes into play. So if you are having a 75% of a common ownership, then you can transfer the asset or liability without having an impact on taxes, subject to the person who is buying the asset or liabilities will record from a tax purpose the original value of the assets which was there in the other group company. So they're giving a benefit of restructuring or recalibrating subject to certain conditions being met. Now, you cannot have something where someone is an exempt person. So if there is someone exempt person, you cannot bring him. None of the person are qualifying free zone person, so 0% tax does not apply. Common ownership interest of 75% should be met. So again, referring you, this transfer we are not talking about where 95%, the three conditions we talked about as a tax group. They're not a tax group, but they are group companies. So that's an interesting benefit. I'm sure it's being thought about to give benefit to the companies to restructure and don't tax them on the capital gain or a value addition which is coming up to. So loss adjustments, again, you can do a loss adjustment between companies which are not tax group. But again, common ownership of 75% and all the conditions of how much tax, how much income we can adjust comes into play. Again, underlying point, without tax group, at least 75% of common ownership. If you have, you can offset again up to 75% of a taxable income. So that's a clause which we looked at. So these are overarching principles or overarching rules which are coming up between the tax group and a non-tax group. Just to give again example of how we can do a loss adjustment. So you can see the parent company is there, 75% subsidiary in mainland. So you cannot have a 40%, it should be 75% plus, and should not be a 0% tax adjustment company. So it can be only, as I said, three conditions has to be looked at again, 75% of common ownership. Point number two, should not have a 0% category of or a exempt category of income company. And third is same financial year. So all those conditions has to be looked apart from the other overarching principles. So I think I'll hold here and Janakji, you can maybe cover the next article on the managerial remuneration. So let me stop here. Or if there is any questions we can cover up, it's hardly 10 minutes or 15 minutes left with us.
One question is there on the chat box. You can see it is a high C sales, which you already covered, but that is the question in the chat box.
Back on high C transactions through free zone. So technically speaking, as we talked about, if there is any transaction which is not touching the custom boundary or a custom border, it is considered as will be classified under the qualifying income and will be subjected to 0% from a tax perspective. But definitely a high C by a mainland will have a different tax implication. So very different taxes coming on the similar kind of a transaction when it is done from a free zone or when it is done from a non-free zone company.
Yeah. Am I audible?
Yes, perfectly fine.
Okay. Only one thing which I would like to say, as you said, managerial remuneration I will cover, but basically which I would like to cover is a definition of related party and controlled person, because the related party definition is very, very wide as per Article 35, that two or more natural person within the fourth degree of kinship or affiliation is considered as related party. So if you see the fourth degree of kinship, if Mr. A and Mrs. A, so Mr. A, four degree upstairs, parent, grandparent, great grandparents, and great grandparents will be considered. And similarly, child, grandchild, great grandchild, great grandchild, all are considered, and including uncle, auntie, brother, sister, niece, nephew, everything is considered as a related party. So as in a lighter vein, we are saying that you need to keep a family tree chart before you can complete the related party analysis. And this has to be done for self and spouse. So take a scenario where there are three partners. So technically, you will need a 6 family chart like this to come to a conclusion who are the related party of that natural person. And secondly, natural person and juridical person, then 50% or greater ownership interest is a one or control the juridical person. Or juridical person means companies. 2 and more companies, then 50% or more ownership interest, or control another company. So these are considered as a related party. And what is the control? And this related party definition is much more wider than the IAS 24 IFRS definition or Ind AS definition of related party also. So in there will be a situation which certain transaction which will not be a related party transaction as per the IFRS standards or as per when we are conducting an audit, or they may not be included as a related party transaction as far as IFRS reporting is concerned. But when it comes to corporate law, there will be a separate transaction which will be considered in addition to the transaction which are covered as a control related party transaction in the financial statement. So this is the one major difference which we need to keep in mind. Second is a control. What is the definition of control? They have control means ability of person of in their own right or agreement or otherwise to influence other person. So if you have a 50% or more of a voting right, or to determine the composition of 50% of board of director, or to receive 50% or more of the profit of another person. These are the three conditions for control. And fourth is to exercise the significant influence. Significant influence is not defined in the law, but significant influence is a power to participate in the financial and operating policy decision of the investee, but it is not a control or a joint control of these policies. This definition we have taken as per IAS 28, and 20% or more of voting right is assumed to have a significant influence. Now, payment to connected person. Friends, one thing we should keep in mind that as we have already discussed, that in case of an individual, employment income is taxable. It is exempt. So when public consultation document came, and they are very clear that any payment, there will be a tendency to make excessive payment to owners or employees of the company, so that to erode the tax base that will be done. And therefore, even in one is payment to related party and payment to connected person are also being covered here. So what is the connected person? The connected person are the owner of the taxable person, director or officer of the taxable person. Officer is not defined in the law, but officer can be corporate officer or high level management executive hired by the business owner or the board of director. Example include the chief executive officer, chief financial officer, president or vice president. So basically every vertical head or a senior management person will be covered by the definition of connected person. And once again, related party of any of this person. So we have to go to 4th degree of kinship of director, officer or owner to have who are connected person here. Arm's length principle, friends, all of you know as per the transfer pricing same. Here I am not going in detail. Only thing they are saying that whichever transfer pricing method you choose, please look into the contractual terms of the transaction or arrangement, characteristics of the transaction or arrangement, economic substance, function performed, asset employed, risk assumed by the related party, and business strategies employed. And as Rajiv Bhai has already explained, that while computing the taxable income, we have to add back the transaction with RP. Only on management remuneration, what I would like to say that I will directly go. The first we will have to determine whether the payment is being made to owner who are the management person, whether is the owner who is managing, and in which case Article 33(4) is saying that any dividend or profit distribution or benefit of similar nature paid to an owner of a taxable person will be not allowed as a deductible expenditure. So therefore, what we are trying to say, if there is any appropriation of profit, then it will be not deductible expenditure as far as company law is, corporate tax law is concerned. Here also, we have already covered that if payment are made to connected person, if the management of the company is done by the related parties. So if they are related party or connected person who are managing the company, then payment to related party and payment to connected person will be subject to arm's length principle as per the international standard transfer pricing guidelines, and therefore that needs to be covered. Secondly, whether there is any regulation in UAE which provides the guidance on managerial remuneration. Yes, Article 171 of the Commercial Company Law prescribes that 10% of the net profit as a total remuneration which can be paid as a remuneration to board of directors. Friends, they are covering only board of directors. So all the connected person and particularly the officers who are not on the board of the companies or board of directors of the companies, for them, this limit will not apply. However, the transfer pricing principle as per Article 35, as per Article 34, 35 will certainly apply. And this, even though this Article 171 applies to the public joint stock company, and Article 104 says that in case of a limited liability company also, if this provision, if their provision for are not covered for the LLC company regulation, articles of public joint stock company will also apply to limited liability companies. And particularly if there are no cabinet decision or council of minister decision which specifically says that this definition, this regulation will not apply to the company. This is same as section 197 of the Indian Companies Act, which restrict the payment of management remuneration to board of directors at 11% of the net profit. Of course, like India also, here we will have to submit document. First, we will have to submit which are along with the return of income, what are the related party transactions and connected person transaction that needs to be disclosed along with the return of income to be filed. Second, businesses will have to maintain master file and local file, which is a normal transfer pricing requirement. And whenever tax authorities ask for details, then within 30 days of their request, we need to give them a master file or local file, or how the transaction are completed in a arm's length principle basis. That also we need to consider. Friend, yes, they may come out and they will come out, particularly for the transfer pricing limit. Like in the Saudi, it is Saudi Riyal 6 million dirham for all the related party transaction and transaction with the connected person. So similar, we are expecting some threshold will come. However, please note, as per the international transfer pricing guidelines and rules, this you need to maintain arm's length pricing documentation, and the value to be considered for that threshold will be as per the arm's length price and not as per the what is the book value of the transaction or transaction value recorded in the books of account.
Yes, Janakji, we have looked at the section also where like small business relief is one thing which is there.
Correct.
So I think
so that they will be not required to maintain transfer pricing documentation, because that is a specific exclusion given in the law. Correct. Now we ask them whether, so just to conclude, way forward for management remuneration. So first we need to decide who is doing the management, whether it is owner, related party, connected person, officer, or independent person. If it is an owner, whether he is doing any function. If yes, we need to maintain a detailed listing of functions which they are doing, and then whether overall ceiling will apply, and related party up to 4th degree of kinship, which we have already discussed, and detailed documentation as mentioned here, which needs to be maintained, where like comprehensive documentation of the key experience of the person, detailed career profile, linkage to the company's operation during the year and future, roles and responsibility of the person, size and area of operation of the company, performance of the company, performance of the industry, internal remuneration policy by HR department or remuneration committee, and last but not the least, that appropriately sign agreement between the director or officer of the company, and that agreement should minimum cover roles, responsibility, remuneration fixed and variable, procedural and administrative action of non-performance of duty, and in the scenario of loss in the during the financial, what will be the remuneration. This all needs to be maintained, which can substantiate that such payment is commensurate to arm's length price, keeping in view the benefit obtained by the company. I know I have rushed much because of the time constraint. Last, I will just add that already in the starting I said that GAR is already here. Article 50 is saying general anti-abuse rule. So GAR is already applicable before the law came into the public domain also, with effect from 25th October 22. And we need to keep that into mind when we are doing any restructuring or any transaction or arrangement. This all of you already know because GAR is already prevalent in India, but that tax and needs to be taken for the same. One more thing which I would like to, before we end, that as per the transitional rules, they are required, the SSCs are required to prepare the opening balance sheet, which takes into account after considering the transfer, this arm's length value of the transaction. So if there are any intercompany balances, their recorded value should be after the application of transfer pricing principles. So technically, transfer pricing, in my view, as of now, is retrospective applicability, which is taking forward, and IS 12, whatever the balances we may take over for the as per IS 12 of the income tax. So that needs to be taken after taking all this thing into account.
So Janakji,
Thank-
from a PP perspective and GAR perspective, we'll look for from the professional help from India also, I'm very sure.
Yes,
Putting into interpretation on that side.
correct.
Interesting points. I
This is,
think,
of course, this slide will be there. There are interesting difference between UAE VAT and UAE CT. This slide will be there. You can, even though it sounds similar, but there are fundamental differences in both the taxes or both laws, which this slide is self-explanatory. Thank you very much. Sorry, at the last we had to rush to complete the presentation, but thank you very much for giving us an opportunity to share our views on the subject. Any questions? We are ready to, very well, we are ready to take any questions which are there. Yes, presentation will be shared. Yes. Except that any questions or something, we are ready to take any question.
so Janakji, Saturday at 6 o'clock, I think everyone has to rush for a
Correct.
good meal and lead back to the panel for, we'll be back to you for taking.
Yeah.
So a lot of compliments for the session in the chat box, if you can just see. Yeah.
Thank you. Thank you.
Okay. So if there are no more further queries, then I would like to propose a vote of thanks on the behalf of JB Nagar Study Circle. I would like to thank CA Rajiv Hira and CA Janak Panjwani for their very detailed and elaborate presentation on the overview of UAE corporate tax and implications for free zone. So your presentation has greatly benefited a lot of members. Almost 300, close to 300 members have attended the meeting today, and they have been benefited from your presentation. Thank you, sir. Thank you for, first of all, accepting our invitation and having spared this much time and explaining the laws to us. Also, I would like to thank Chairperson Dubai Chapter for his opening remarks and sharing his insights. Next, I would like to thank our coordinators for today's event for helping us out in coordination. Now, last but not the least, a big thank you to all the members for coming and attending the session. Thank you. Thank you all. Thank you, sir. Thank you, both of you.
Thanks, Purvi.
Thank
And
you.
we all are
Thank you.
available on the social media. We keep posting a lot of articles and sessions. So always welcome to connect, and looking forward to see
Yes,
you.
I'm sure a lot of members will be willing to connect, sir.
So
Thank you
looking
so
forward
much.
to seeing some of the members in UAE also. Take care and
Yes,
wish you
sir. Thank you.
Have a
Yes,
nice
sir. Thank you,
weekend.
sir.
Have a nice weekend. Thank
Same,
you.
same.
Thank you. Namaste.
With your permission, I'd like to close the session now.
Yes. Yes. Thank you.
Thank you.
Thank you.
Thank
Thank you.
you.